14 years have gone by so quickly, and one year after another and after another, but I always love coming out, seeing everybody, seeing our customers and friends and all the rest, and it's wonderful having you here today. So, there's a lot to talk about today. Obviously, we're living in very interesting and some would say troubling times all over the globe, what's happening economically here in the United States, and again, all over the globe. I'm going to cover a lot of territory today. A lot of territory, and I'm going to get technical at times with you, and I apologize for that, but some of the issues that I'm talking about are so impactful to your assets and the economy. Because a lot of times, people wonder why things are happening in the equity market or in the real estate market, not fully understanding what's going on behind the scenes in the plumbing of our financial system that have such huge, profound effects on their assets and on the economy. So let's get going. All right, these are last year's predictions. I will tell you right from the get-go, I was pretty good, but nowhere near as I was the year prior. I'm not going to go through all of them, though, right now for one simple reason. I have too much to cover today, but I wanted to put them all up here so all of you can go look at them, judge them on what hit the bullseye, what were on the board, and what missed the board. And I will tell you the ones that missed the board, such as my prediction that the U.S. economy would be in recession, that the unemployment rate would rise, that we would have a bigger market sell-off, and my interest rate prediction were all tied into one general theme. And you will see, and I'll walk through why the economy remained more resilient, and I'll address that right from the get-go of my presentation. So let's get going. So the economy remained more resilient. In fact, we had our best quarter this last quarter, third quarter. The economy grew at 4.8%. In the first part of the year, it was 2.2% the first quarter. Second quarter was 2%. So all in all, in 2022, if you recall, we had a couple quarters of contraction. This year ended up being okay from an economic growth standpoint. Consumer spending, big part of that. The consumer remained very resilient. This just shows month-over-month change in retail spending. This last month was 0.7, pretty strong. Now, it's interesting. Look at where people spent money. Food services, that's restaurants. Healthcare, retail and food services. Where is that spending coming from? Because remember, during the lockdowns, people couldn't get out. And finally, everybody, COVID's over, thank God. I'm not having to talk about it this year. It's over. People were out. They're out at concerts. They're out at sporting events. They're out at restaurants. And restaurants really boomed and did well. Now, interesting enough, look at the ones at the bottom. Furniture, building supplies. Those were the ones a couple years ago that were exceptionally strong. People were buying new furniture for their home. They're locked in and they're sitting on the internet and doing things of that nature. All right, now let's look at, I call it the tale of two economies. This is US ISM manufacturing PMI, and this is services PMI. So when you see the line 50, anything over it means expansion. Anything under it means contraction. So if you look at what's happening with our manufacturing sector, it's been in contraction for the last 10 months. So, and then if you go down to services, that is still in expansion, slowed down a bit. So we really have a tale of two economies. Our manufacturing sector has already been in recession. There's no question about it. But it's our service sector, and what I'll get into in a second, that's really been propping things up. All right, employment. This is the U3, which is what they report. U6 is really kind of the real unemployment rate that people track. But both of them have remained exceptionally resilient, very, very strong. We're kind of at record lows, kind of where we were before COVID happened. So the employment sector is doing very well. But there's some interesting dynamics that are happening in the employment sector now. And what do I mean by that? Full-time workers actually lost jobs last month. Where were the gains? It was part-time workers. We had a surge of part-time workers. And my belief why that is happening is because inflation is crushing a lot of people, and they're needing to go out and get a second job to support their lifestyles and the debts that they have racked up. All right, so what's the best way to avoid a hangover? As you all know who've been coming, is I've had a theme ever since the lockdowns when the money gates got flooded open by the U.S. government and by the Federal Reserve. Remember, we spent money like mad. And then the Federal Reserve printed ungodly amounts of money at a level we have never seen before. So, when you drink too much and you party too much, what's the best way? I guess just keep drinking. Have your Bloody Mary in the morning. So here are the three main reasons the economy has remained more resilient this past year. Federal, state, and municipal government spending, a resilient consumer, and this one's going to confuse everybody. The failure of Silicon Valley Signature and First Republic Bank. You would say, why would the failure of three very large banks cause the economy to do better in the capital markets? I'll get into that and show that in a second. All right, so let's start off with federal and state and municipal spending. On your left, as you're looking at this is all the different spending bills that happened. The CARES Act during the first big bill during the lockdown, the Consolidated Appropriations Act, and other related spending of $400 billion. Then we were coming out, President Biden got elected, and even though the economy was starting to come out and do well, he came in with the American Rescue Plan of $1.9 trillion, backed it up with another $1.2 trillion for infrastructure, a CHIPS Act for $280 billion, Inflation Reduction Act of $437 billion. We spent $7.32 trillion, an ungodly amount of money. Now, what you're looking at with all these red and blue dots is the red dots are formula spending when the federal government gets tax receipts. They have a sharing relationship on a whole lot of things with states and municipalities. That's money that got extra pushed through for public projects. The blue dots are discretionary spending by the states and municipalities. So what has happened? All that money that got pushed in, the states and municipalities, cities, counties were sitting on this massive wave of money, and now it's all been released. So in my home state, Wisconsin, we often say in Wisconsin we have two seasons. We have winter and construction season. Well, this year, construction season has been off the charts. I mean, when I drive out of my home in Madison, if I go to my right, there's construction on that road. If I go to my left, there's construction. I only got one road to get out. And then once I get to the big road, I've got construction the whole way. The whole city. I live in a university town. University of Wisconsin Badgers. Go Badgers. But they have ripped down buildings and building huge buildings. I mean, the amount of spending that has been done by state and local and federal governments is just unprecedented like we've never seen before. And then you look at what's happened with the corporate welfare because of the infrastructure bill, because of the CHIPS Act, because of the Inflation Reduction Act, which had a lot of green energy subsidies. This is semiconductor, clean energy, batteries, biomanufacturing, heavy industry. Think of Micron's plant up in Boise, Taiwan Semis. This is happening all over the country. These are big, big public spending projects. Now, frankly, I think part of it was done by the Biden administration on purpose. Push through a lot of money, let them spend a ton of money right before his election will come up. A lot of presidents do that, so I'm not blaming them for them. But this was an unprecedented amount of money like we've never seen spent before. Okay, so what were the issues that lifted the consumer? Why was the consumer more resilient? I'll say there's 4 main reasons for that. If you look at the upper left hand, excessive savings, what does that mean? During COVID, when everybody was locked down, people couldn't spend money, so they were saving it. Most of them still had jobs, and if they got laid off, they were getting supercharged unemployment benefits. Plus, remember all the checks the federal government was sending everybody. Stimulus checks. So people, the consumers, racked up $2.2 trillion of excessive savings during the COVID lockdowns. Now, as you can see, that trend line's coming down. In fact, J.P. Morgan, Jamie Dimon has done a lot of work on that, and they talked about that the excessive savings would run out about this time right now of this year. Second issue, if you owned a home, you benefited massively when rates collapse. So this is a monthly mortgage payment on the bottom left of a $500,000 mortgage. And if, let's say, your monthly payment was about $2,500 and you refinanced, all of a sudden you were saving about $574 a month. So what is that, over a whole year? I mean, you're talking 6 or 7, close to $8,000. That's a lot of extra juice in a lot of people's pockets. Then you have the upper right-hand graph, student loan repayments. Remember, we have $1 trillion of student loan debt in this country. All of a sudden, federal government said, you don't have to make payments on your student loans. So people all of a sudden had this, found savings. And over that time, that was $185 billion that was subsidizing the consumer. Now, that is coming to an end. It just came to an end in October. And then lastly, credit card balances. As you can see, credit card balances dove because everybody got those stimulus checks. They built up savings. They paid down their credit cards. But this past year, credit cards usage went through the roof. So these are the reasons the consumer stayed stronger. Now, I had a graph last year. Every time the Fed raises rates, they break something. And, from the Latin debt crisis to the stock market of '87 to the S&L crisis to the tech bubble, the great financial recession. And this year, as I predicted, they'd break something. It was SIVB, Silicon Valley Bank Corp, Signature Bank Corp, and First Republic. And they're going to still break something more. But why would that help the economy? Well, these are the officials that run the U.S. economy, and one of them runs the banking industry. The head of the FDIC, Janet Yellen, the head of the Treasury, and Jerome Powell, the head of the Federal Reserve, obviously. So they hatched a plan really immediately to save the banking system and avert other crises. So what did they do? Boom! They pumped money into the economy of almost $400 billion in a month. So what you're looking at is the Fed's balance sheet, just a small little glimpse of the Fed's balance sheet from January 22 to October 23. I'm going to do a little refresher. Remember, how does the Fed put money in and take money out of an economy? It's through quantitative easing or quantitative tightening. So what is quantitative easing? That is how the Fed injects money into the economy. How do they do that? They buy treasuries, mortgage-backed securities off of banks, pension plans, insurance companies, and send them cash. That is shoving money into the economy. What is quantitative tightening? It's the reverse. They're letting those securities roll off or selling them back into the market and pulling cash out of it. So the Fed had pushed $5 trillion into the economy during the lockdowns. They were starting every month to take it out, and then these failures happen, and bam, they shoved $400 million into the economy like that. So as a result of that, an after party kicked in. hey guys, the party's over, but we got a new round of booze over here, so everybody get on over here for the after party. So what ended up happening? The equity markets that got pulverized in 22, ended the year with a little bit of a rally, then started a little more of the rally at the beginning of the year, and then started having a sell-off, and then during the failure, those banks sold off, and then all of a sudden the money came in. Boom. And whenever they inject money into the economy, you can wait 2, 3, 4 weeks, and then it will build on itself over the next 1, 2, 3, 4 months. And that's exactly what happened. And interesting, the sectors that got most hit last year, basically the tech sectors, communication service, information technology, that really got hammered at the end of 21 and all through 22, performed the best. And some of those industries real estate's just getting killed because of what's happening with rates, but even like utilities, again, tied to rates. But it's just a flip for a lot of those industries, what performed well and what performed poorly. So, what was the big drivers of the equity market? I call it the Magnificent Seven, or I shouldn't say I call it, that's the new term out there. What are the Magnificent Seven? It's Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla. These companies now account for 29% of the total S&P 500 market capitalization. They're trading at 43 times last 12 months earnings versus the rest of the S&P, if you back them out, trading at 14.9 times earnings. To me, this is insanity. It makes no sense. I'm sure a lot of people in this room own Apple stock. But I'm sorry, when you're already at a $2.7 trillion market cap and you got almost a 30-time forward PE and you really don't have any earnings growth, that is really hard to sustain over the long haul. But people view it as a safety vehicle. But you can go through all these names. I'll just say, remember 20 years ago, Cisco was the giant in the technology sector. Stock so high, so strong. Look where it is today. Or how about 30 years ago, IBM? Look at where the stock has gone over a long time. So I would just forewarn people that don't expect past performance to equal future performance. Okay, so one thing I talked about last year was profit margins. That's the graph to the left. As you can see, profit margins, which usually in the corporate sector is around 6 to 8%, skyrocketed during COVID. They had all this pricing power. All of a sudden, inflation took off. They were able to price their goods. But a lot of the cost was lagging. They weren't having to pay their employees. All of a sudden, you got, boom, pricing power on your products or services, but your employment costs weren't there in all your other costs. Well, it caused this big spike. And I said it would come down, and it has come down. It's continuing to come down. Little hookup, but I expect this to continue to come down. That's troubling for the equity markets because the lower the profit margins, it's harder to sustain that. Now, the forward PE multiple on the S&P 500 is 17.3 times. Rich, not super rich. You got to be careful. Like in 2021, companies were just earning not much money because it was a recession. So even though the equity markets weren't doing that well, it just looked like it's a high PE. But for companies that are earning a lot, 17.3 times is a pretty rich multiple. So it's a little concerning where the equity markets are from my standpoint. Don't get me wrong. There's a lot of good value to be found. Our equity markets, in my view, are broken for a variety of reasons. I don't have the time to address it. But you have companies that you can find at very cheap values that are growing and doing well. But then you've got things like the Magnificent Seven that are priced to perfection. All right, because of this after party, inflation has remained sticky. And it hasn't been coming out quite the way that the Federal Reserve would have liked. So here is a graph on CPI, Consumer Price Index, and here's a graph on PPI, Producer Price Index. As you can see, they both spiked. By the way, the blue line is headline, core is what the Fed defines as core, and this is laughable. Headline includes energy and food. Now, you would think energy and food are core, but the Fed says it's too volatile, so we put that in headline, and core is everything else. But the thing I want to have people recognize, and most of you already do recognize this, when they say inflation is coming down, that doesn't mean prices are coming down. That just means the increase of prices going up is slowing. Okay? So the Fed wants to get the rate of the increase of prices going up to 2%. They're having a heck of a time getting it down there because of all that money that got shoved in. Look, I'm a monetarist. All this nonsense about transitory inflation was a joke. If you print too much money, it's going to cause inflation. What is inflation? Too much money chasing the same amounts of goods and services. Plain and simple. So they increased the money supply. The federal government has spent way too much. They created this massive inflation wave. You could see it by how much the federal government spent. And now we're saddled with this. So it's taking time to get it out of the system. I want to walk you through this refresher too, because it's important to my last point on there. When money comes in through quantitative easing or the federal government spending, what does it do? It first hits asset values, stocks, bonds, real estate. Then it moves into the price of goods, the things you buy. Then it moves into the price of services. And then it goes into wages. Now, inflation in 22, the asset values got cracked, so inflation started coming out of asset values, not fully, but a lot of it. Price of goods have started to finally roll over in many cases. Price of services have remained really sticky. And then you have wages. And if you recall this graph from last year, it's called the wage price spiral. This is what the Fed is concerned about. You get inflation, it causes higher price of goods and services, higher demand of wages, higher labor costs, which produces more inflation, and it just keeps rolling and rolling. So what's been happening this past year? Well, unions demand higher wages and benefits. I understand it. You're a poor working guy, working class or middle class person, you're just getting hammered by the inflation that has been created. And so, of course, you're going to ask, hey, I need to be paid more. So these are just some of the deals. UPS drivers, they're now going to be able to earn $170,000 by the end of their 5-year contract. I guess everybody should tell their kids to go be a UPS driver. It's a hell of a job. It's better than going to a 4-year college, racking up a bunch of debt, and then going working at Starbucks, Healthcare, Kaiser Permanente, they just agreed to a big new deal with 21% pay increase. UAW, all the big 3 automakers, anywhere from 25 to 33% price increase. Now I'm concerned about that because the automakers are already saying they're going to have to increase prices on all their vehicles. So remember, wage price spiral. Major airlines, a 46% increase. Have you guys seen the price of airfares? They're through the roof. Major airline flight attendants, 36% pay increase. And then I just had to throw it in. Culinary and bartender unions in Vegas. They're saying, hey, we want to get paid more. Everybody wants to get paid more. And I understand that. I fully understand that because they've been hammered. So this is the issue and why it's going to take more and harder to wring out the inflation that's in the system. So Milton Friedman, one of the greatest economists of the last 100 years, has a great quote. Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first and the bad effects only come later. That's why in both cases, there is a strong temptation to overdo it, to drink too much and to print too much money. Well said, Milton Friedman. All right, so because of this after party getting out of hand and inflation not coming down, the Fed had to come in and bust up the after party. So what did the Fed do? Well, These are different lines of increases in interest rates depending upon the time set. So 2015 to 18, 1999 to 00, 94 to 95, and so forth and so on. As you can see, the dark blue line that has gone boom, straight up, that's what the Fed has done. We've had the fastest increase in interest rates from a percentage standpoint we've ever seen because they've had to address this inflation. So let's talk about the housing market. Housing and real estate, commercial real estate, are the next two sections I'm going to talk about. Why do I put them right after I talk about interest rate movements? Because there's no assets that are more influenced by the price of money than these two sectors, real estate. Why? Because think of it, you finance a home 80, 85, 90%. Commercial real estate, 60, 65, 70, 80%. So increases in interest rates really impact both the housing market, and by the way, this is the most important asset for the American consumer, and obviously commercial real estate, which a lot of you here and online own. So what's happened in the housing market? Rates have cracked and crushed housing activity. The first graph is U.S. existing home sales. It is just absolutely plummeted, down 38%. Mortgage applications have absolutely collapsed. We're back to, I think, 1985 with mortgage applications this low. Historically low inventory has supported prices remaining a little stronger. Now, I thought prices would drop. It's one of mine that's on the board. I wasn't off the board. I didn't hit the bullseye. Prices have dropped, but not as much as I would have expected. Why? Because inventory has collapsed. There is just no homes to be found out there today. Now, there may be a change that could happen in the coming year, one piece of it, and that is investors. The third bullet point talks about investors started buying and buying over the last 12, 14 years, a massive amounts of home, and they bought 16% of all homes. They're now buying 45% less, and if those investments on an Airbnb home or just a rental homes don't start working out, you may start seeing some more inventory. But if more inventory comes in, then prices are going to come down more. This explains why there is no inventory. Okay, so this is a portion of mortgage loans below 5%. The gray line, the light gray line, is mortgages at 4 to 5% range. The light blue line is mortgages that are at 3 to 4%. And the dark blue line, which was very small amount until what happened in 2020, shot up, which are now 22.9% of all mortgages are below 3%. So everybody went out and refinanced. Now, the amount of those people that didn't have a mortgage below that, a lot of them are mortgages at the end of their life. They're elderly people, in their late 70s, 80s. They just didn't even want to think about it. It didn't matter to them and all the rest. But the vast majority of our mortgages today in this country, in fact, 60% are below 4%. Well, think of it. How are you going to sell your house even if you want to sell it and go buy a new house, a bigger house? You're going to go from a 3 or 4% mortgage to a mortgage of 8% today? You can't. The payment shock is just dramatic. And I'm sure all of you know somebody in your life that is facing that very dynamic. So this has really helped freeze the housing market. And as a result of that, affordability has collapsed where we are with rates. And young people can't buy a home. This is a sad dynamic in our country because home ownership is such an important tool for the middle class and the working class to get ahead and have a savings. And for young couples, what happens? You find your spouse, you get married, you may start looking at a home, but if you have a child, you definitely want to get a home. And if you can't get a home, it's kind of hard to have more children in an apartment. Not to say you don't, but we know home ownership creates family formation and is positive for that. And frankly, our birth rates around the globe and in the US have really slowed down to a level that's not good. So this housing affordability is becoming a very relevant factor. Okay, and now this is rents. I had to talk about rents because I know a lot of people who bank with us own multifamily. So rents took off because we don't have enough housing, but rents are starting to roll over because in some markets we overbuilt. The left or the right graph is apartment rents year over year change, and we just dipped negative. But you know, people in apartments that didn't own a home didn't get the benefit of refinancing a mortgage lower. So the rate of inflation in apartment rents was outpacing their income levels. So we're really, again, in like bifurcating our economy in a way that's not necessarily the greatest thing. So, you know, if you're middle or working class, you didn't have a chance, or you're younger, didn't have a chance to own a home, you didn't get any of the benefits of low rates, but you got fully socked by all the negatives of the inflation that came through. But fortunately, rents are starting to roll over. All right, commercial real estate. You know, if you went back to the great financial recession, what got hammered the hardest? Residential real estate. Commercial real estate got beaten up too. But the big recession of the late 80s, early 90s, housing did pretty well, and commercial real estate got hammered. Well, unfortunately, I think we're entering into a period of the late 80s, early 90s for commercial real estate. So let's look at it. CRE transaction volumes have collapsed. This is just showing office, multifamily, retail, industrial. You can see how transaction volumes have just fallen off from the sky. You know, commercial office transactions were only $6 billion in the third quarter. I mean, that is almost nothing. But it's happening to all areas. Next, cap rates. When you think of a cap rate, just think of a yield. A cap rate is nothing but a yield. So when you look at a multifamily cap rate today, current rate of 5.6, that just means you get a 5.6 yield, kind of like if you put money in a CD, you know, I get a yield of 5.6. But cap rates are starting to move up. Now, I know a lot of you in California are looking at these cap rates, the low rate, and going, come on, multifamily, that was going at 3%, and industrial could be going at below 3%. This is for the whole country, from small little projects, you know, C product to Class A product. So in parts of California, parts of the booming areas in commercial real estate, some of those cap rates got 3, sub 3. But now cap rates are on the move. My view, these cap rates are only going to grind higher. Why? Very simple. It's very hard to make it work when your financing cost is higher than what your cap rate is. And the only way to justify that is continual pricing increases on rents. But that has slowed down now. So I think cap rates are only going to continue to grind higher. This is the big problem. This is the very, very big problem for commercial real estate. This is a wave of commercial maturities that are approaching. In the banking sector, the CMBS market, the life insurance market, life cos, debt funds, and GSE. So you have 4 main arteries of finance in commercial real estate. Banks, CMBS, life cos, and debt funds. If you're in multifamily, you have a 5th, which is the GSEs, Fannie and Freddie. You're going to have $728 billion mature this year. $659 billion mature next year, and then $539 the year after that. Why is this a problem? Because most of that $728 billion was financed at vastly cheaper costs. So let's look at the math behind it. Let's say you owned, I don't care, multifamily, office, whatever, property. You had a loan of $10 million. You financed it at 4%. Your NOI, your net operating income on that asset was $600,000. At a 4% rate, your interest cost is $400,000. Therefore, your cash flow after interest payments was $200,000. Therefore, you met the bank's requirement of a 1.5 debt service coverage ratio. Okay? That's how we bankers look at it. We want to have cash flow that supports the interest payment. Now the loan comes mature. You got the $10 million loan. You've got an 8% interest rate. You still have your same NOI of $600,000, but your interest cost is now $800,000. That means you have negative cash flow of $200,000. Okay, so your banker says, what are you going to do about it? Because we're not going to refinance it. So you're going to have to come in, and let's say the banker's nice. I wanted to use a conservative example. The banker says, you know what, I'm going to lower your debt service coverage ratio from 1.5 to 1.25 to help you out. Because banks will finance at 1.25. So I'm going to do that. But at 1.25, you're going to have to bring a check of $4 million to get that loan down to $6 million, because again, at an 8% rate, your NOI is still $600,000. Your interest payment now on $6 million is $480,000. So your cash flow after interest is $120,000, so you meet the 125. This is the problem, folks. You have a massive wave of maturity where people are going to have to cut checks, big checks, to right-size their loans. And if they can't, you're going to have to pray and hope that the lender really works with you, which some will, depending on how much you're going to financially support that asset, or the banks are taking it back. And then that's going to be sold. So you're already starting to see this. Delinquency rates at U.S. banks have spiked. Retail, office, multifamily, industrial. The right is commercial real estate charge-off at banks. Again, spiking. And these numbers are straight line going up, and they're not going to slow down. And what's going to happen as banks go into take these assets, they don't want to hold assets. They're going to pitch them out. So there is going to be a big wave of distressed sales. It's going to be a great buying opportunity for those that have money to take advantage of it. But it is going to cause a lot of pain and continue to hammer the values of commercial real estate. All right. If you watch the financial news like I do all the time in the morning, you know, are we going to have no landing? Are we going to have a soft landing? Or are we going to have a hard landing with the economy? I manage money in the equity markets for a long time. I still do for myself, but I don't do it for institutional investors anymore. But I used to have a group of people sit around a table that managed money with me, and I'd always give this comment to them. Don't ever forget that the biggest BS manufacturing plant on planet Earth is not where they kill cows in Kansas or pigs in Iowa. It's Wall Street. Because Wall Street makes more money if the capital markets are going up, and they want the equity markets to continue to surge, and the economy and all the rest. So you're going to hear a lot of things when you watch the financial news. Just take that with a grain of salt in what you're hearing. Wait to listen to the people that really understands things and talk with data. So let's talk about data and what will influence the economy. There are three ways that the Federal Reserve influence the economy in a significant way: the cost of money, the supply of money, and the creation of credit. So let's get into that. Well, the cost of money is increased dramatically. You can see it. This is Fed funds rates, 2-year, 5-year, 7-year, 10-year, 30-year fixed rate mortgage. Just 2 years ago when I was standing here, rates were rock bottom low across that whole thing. A year ago, rates had gone through a big increase, 300 basis points on the Fed funds rate. The 10-year had increased 245 basis points. Then you go to now, and this is the massive increase of further rate increases that have happened. Another 225 basis points on the Fed fund rates, down to 73 more basis points on the 10-year Treasury. That just backed up. That was at 5% just last week. So, but a huge increase in rates. So the cost of money has gone up. The supply of money. Well, we had a massive increase in the supply of money like we've never seen before. You see that in that red box over on the left graph, just straight up 39%. Never in our country's history have they increased the money supply that much. And now it's turning down. You can see it hooked down, and over here, the month M2 money supply year over year is really dropping. We've never seen them take this much money out of the economy this fast. And the liquidity is continuing to be drained. Again, this is the Fed's balance sheet. This was the Fed's balance sheet started in 2007 before the great financial recession. Then you see this big bump up because it was sitting at about a little under $1 trillion. Then it went up to over $2 trillion. Then they continued to jam money during the Obama years. And then President Trump got elected. They started to drain. The economy was doing pretty well. They started to drain. And then the lockdowns happened, and boom, straight up. So they took their balance sheet to $9 trillion. And by the way, what you're looking at, the dark blue is their holdings of treasuries, and the dark red is mortgage-backed securities. So boom, the balance sheet increased. But now you can see it coming down, and they're draining and draining and draining. After that injection, because of those bank failures, once things got stabilized, they're back on taking money out of the system. Now let's talk about the creation of credit. Banks create credit, but a big part of banks creating credit is deposits. And deposits have turned negative. You had one quarter and second quarter of a 0.3. Again, all that money came in. We don't have, it's literally another week or two we would have it for Q3, but I can guarantee you it's going to be a big negative. So we had 4 negative quarters, 1 modest up quarter with that injection by the Fed. And over here you can see the red line. These are the large banks, and the blue line is the smaller banks. Very interesting. Everybody talked about when the crisis came with Silicon Valley and First Republic, everybody pulling their money out of small banks, put it into the big banks. So you saw that spike up with the red graph and the drop down with the dark blue graph, the smaller banks. But in reality, after that happened, the smaller banks are gaining deposits and the big banks are continuing to drain. Part of that reason is a lot of people took their money out, went to the big banks, and realized they get such terrible service and they don't even know who to call and all the rest of saying, this is miserable. I got to get back to my regional or smaller community bank or your business bank like Sunwest. So the big banks have lost a lot. But this ties into credit creation. If the banks don't have the funding to make loans, then creation of credit goes down. And you can see what is happening. This is the tightening of lending standards. Commercial and industrial loans, business loans, have collapsed. The banks have ratcheted down 46%, and commercial real estate's down 68%. It's really hard, as many of you are investors in real estate, to get commercial real estate loans today. Extremely hard. We're one of the only banks out there continuing to lend because we went into it with a fortress balance sheet and we lend in good times and bad times. But we've tightened our standards as well. So this is what's happening with the creation of credit. Now, again, cost of money is going up. It's going to slow the economy. The supply of money is going down, going to slow the economy. And the creation of credit is contracting. I put out a video, and I don't know if any of you saw this, right around Silicon Valley and all the rest, why this will hammer the economy. Think of banks as gas stations. If there's a lot of gas stations and gas prices are cheap, you got a lot of cars and trucks moving around the roads and highways. If all of a sudden the price of gas starts going up, interest rates on money, well, guess what? Less cars are going to be driving. And if all of a sudden a lot of gas stations close or are not providing any gas, then you get a massive slowdown of the cars and trucks moving on the economy. This is why I don't believe at all there's going to be no landing. It will be either a soft or a hard landing. But let's look at some other data to look and see what other things are going on outside of what the Fed is doing. Troubling trends. So I got to laugh about this. This was the most hotly debated graph of the whole thing. which is so ironic, by me and the people that put this together, the few young guys that helped me, what's the photo from The Hangover that is good? So we debated this one back and forth. I said, guys, you figure it out, but I like this one. So, all right. So I'm going to walk you through a few graphs that are troubling trends. Okay, this is the yield curve. I've talked about this before. Every time we go into a recession, the yield curve inverts before that recession. However, not every time the yield curve has inverted have we gone into recession, but that's only happened twice. Invariably, an inverted yield curve will lead or is a predictor of a recession. And ironically, it's when it starts to uninvert, which is called a bear steepener, which I just don't have time to get into. That is when you see the economy enter. So remember, the gray bars are the recessionary periods. Every time you can see the yield curve inverts, a recession typically comes 15 to 18 months after the yield curve inverts. And we're right there right now, just so you know. And then as it starts to uninvert is when the economy goes into recession. Next, real wages. Well, we had a surge in wages because inflation, everything going up. Real wages, factoring in inflation, real wages have gone down, which is why all those unions and employees are demanding higher wages, because inflation has hammered them. And when you start seeing real wages go down, again, the gray bars are recession periods, you see the economy always enters a recession. Next, this is a very interesting graph. Okay? The blue line is the personal savings rate. Remember excessive savings I talked about earlier? Look at how it skyrocketed during the lockdown because everybody was getting checks and nobody was spending money, and they didn't have to pay their rents, they didn't have to pay student loans, so people were just piling up savings. The red line is credit card usage. As you can, it's hard to see, but the red line went down. But now, where are we today? That's the question. Savings rates have collapsed. It's now back as low as we've ever seen. And credit card usage has skyrocketed. And by the way, the cost on credit cards today, it's gone from 6, 8, 10% to 20 to 30%. It's hard if you're borrowing at those levels to sustain it. All right, then we can see consumer delinquency. Remember the consumer, it's such a big part of the economy. Delinquency rates on the left. It's still rather moderate towards the last spike and sometimes in the past, but you can see it going straight up. But the rate of change is like we haven't seen before. People are going delinquent at such an incredible pace. And subprime auto credit, that's at the highest it's ever been. So the consumer's cracking as we're talking. Very sad, but that's what's happening. Now let's look at the corporate sector. Corporate bankruptcies, which kind of fell off, are now starting on the rise. And this is going to start impacting the economy as companies go bankrupt. We've had a lot of big companies. Yellow, which is a big trucking company, Bed Bath & Beyond, obviously Silicon Valley Bank. There's 400 plus. But that's sustainable, but what's coming for corporate bankruptcies? This is the next graph. Just like commercial real estate, but fortunately for businesses, most of their financing needs are pushed out to 25, 26, and 27, and 28, but you still have a big amount of maturities coming across the board for businesses. I can't believe this when I heard this, and I heard it multiple times, and we had to verify it. But if you took interest rate costs to today's level, 29% of the S&P would be unprofitable. That's wow. And what's going to happen is companies are going to go, okay, my debt maturity may not be coming tomorrow, but my debt maturity may be coming next year. I know my interest costs are going to skyrocket. I got to start saving money. So they'll start investing less and slow their capital investment down, which I will further slow down the economy. Okay, I'm going off topic on economics, even though it does have a direct economic impact. But I found this one really disheartening for our country. This is a poll of National Federation of Independent Business, small business, and they ask them every year, they've been doing this forever, what are your biggest problems? Dark line, inflation, blue line is tax, cost of labor is yellow, quality of labor. Quality of labor really was never a major significant thing until recent. Quality of labor is now equal to inflation. Think of that for a second. The quality of labor. Well, a Pentagon study came out in 2020 that 77% of our young Americans do not qualify for military service. 77%. Due to drug abuse, mental health, or obesity. It is very sad what's going on with our younger generation, and it breaks my heart to see a variety of things. What made them less productive? What made them less resilient, less grit? In many cases, there's some wonderful, strong young people out there, don't get me wrong. But as a whole, how could we have 77% do not qualify for military service? I don't know. You know, bulldozer parents didn't help. Not having kids have a summer job growing up. I know everybody in my baby boom generation, we all had jobs. I don't care if it was working at the McDonald's or whatever, or mowing lawns. You know, our food we intake, all the rest. But for me, it's this damn device that has been so corrosive, and social media, and you can even see people work. I mean, you see it. I have a buddy who is a big developer, and every time he walks to the construction site, he says, it drives me nuts, because I see people, instead of hammering nails and building, they're sitting there looking at their phone. You know, you can go into restaurants, you can go anywhere, and you see people constantly doing that. It's insane. So it's a problem because, you know, if you've tried to get health care, our healthcare system's breaking. We don't have enough quality people working in our healthcare system to get access. Police, you know, after this big nonsense defund the police moment, I'm sorry, was that not the stupidest thing you've ever heard? Defund the police. Who are you going to call when somebody's trying to rape you or kill you? A social worker? Yeah, right. But you can't get police, healthcare, education. This is a real problem in our country. Real problem in our country. All right, mismanagement of energy resources. So, a big part of inflation, because energy goes into everything we make and how we move ourselves and all the rest is energy. Well, energy prices came down as the Fed was tightening and draining money, and the economy around the globe was slowing. China didn't get their boom, I'll talk about that. But now energy prices are starting to pick back up. And we have some structural issues that could make energy prices very problematic going forward. Very problematic going forward. So, you know, and with what's going on in the Middle East could only exacerbate it. So we need, no matter, you know, look, we do solar lending. I want to support green energy. But the reality of it is our country has spent $5 trillion on green energy. It has barely moved the dial. It's time, a big dose of realism, that we need natural gas. We need oil production. We absolutely need this. Now, this. And I don't like getting too political, but there's no way around this one. This is the Strategic Petroleum Reserve. This is what our country keeps in the case of a natural disaster, in the case of a war, that we can continue to operate aspects of our economy if we get into a severe crisis. This is not meant to try to influence the price of oil. It is there only for an emergency. As you can see, our country largely kept 600 to 700 million barrels of oil in reserve. that would give us about a 33-day supply if all energy production just shut down, which God forbid, let's hope that never happens. But certainly a hurricane like what happened in the past could whack out a big part of our energy production in the Gulf like that. So that's what this is for. Well, President Biden, what he did, because he wanted to push gas prices down to help with his political standing, drained off almost half of our strategic petroleum reserve. Now we're sitting here in a position where we got 2 wars going on, and they know they have to rebuild it. And this shows you how not very intelligent a lot of people in the government operate. They come out and say, we'll buy, we'll buy at $70 a barrel. Well, if you're an energy trader, you go, okay, that's my floor. So I can buy above $70 a barrel because I know my downside is 70, but my upside's a lot higher. So because they couldn't buy any at $70 a barrel, they moved it to $79 a barrel. So now energy traders, so okay, my floor is 79. So, okay, I can buy it at 79. Yeah, they won't, it could go a little bit lower, but largely that's where they're stepping in. But I got really little downside, but I could have a lot of upside. All they're doing is setting the floor. They shouldn't say a dang thing to anybody. You don't go, hey, I'll buy your real estate asset at this price. You be quiet about how you operate, but not too smart in how that's been done. So, this is not good. Politics should not be involved with this, and unfortunately it was. All right, global markets. I'm going to cover this very quickly because we're running out of time. So, China. China's growth story is over. Plain and B. It's been a 30-plus year growth story, and China, I even thought you would get a bit of a boom once they came out of their lockdowns, and they really didn't get much of a boom. It was a very little blip. But their trend line, as you can see on the upper left-hand graph, is GDP growth rate, just sliding down. If you go to the right upper graph, this is foreign direct investment. The red is negative direct investment, the blue is positive. China had massive amounts of foreign direct investment by US and European companies building factories and plants in China, and which helped drive a lot of that growth. You had a temporary dip during the Trump battle with them in tariffs and some companies that need to reposition, but then it pretty much spiked back up. But now it's going down, and it's going down hard, and it's going down fast, and I don't think that's going to change. And you're seeing a big repositioning out of factories, out of China into Vietnam, Mexico. Mexico's booming because of it. Onshoring back here. I mean, we got 95% or 90% of all our pharmaceuticals were made in China, and even our antibiotics. It was insane. And now I think we had a wake up, and some of that supply chain needs to be brought back. So that's going to hammer China. Housing market, I spent a fair amount of time last year. They have an epic housing bust, and I mean an epic housing bust. They've got like 60 million unoccupied units. They built building cities with nobody even living in them, and now their real estate is collapsing. And then lastly, youth unemployment. China's youth unemployment is at 21.3%, probably understating it. And what does the government of China do when the numbers get bad? They just stopped reporting it. So that's as of July. We don't know. So that's what China does, just makes it disappear. My wife and I were in China because her brother ran IBM, the market of China and much of Asia. And I always remember going there every day. Blue sky, wonderful, perfect. And I'd look out, gray steel sky, so much pollution. I'd be like, wow, their news, very different than ours. All right, Eurozone. Europe has entered a recession. I thought Europe would get more hammered this last year. Europe got saved by one of their warmest winters. They were on a verge of a massive crisis because of the war in Ukraine and Russia and the energy supplies. And thankfully for the Europeans, They had a very warm winter that they reduced their energy usages. But Europe is now rolling into recession. These are just a few of their bigger countries: Spain, France, Germany, the economic engine of Europe, down 0.1, Italy, and Ireland. Their headline inflation is coming down. They still have it. All sectors for them, their PMI, both manufacturing and services, are in recession. All right, so let me now talk, and I'm getting ready to wrap up, folks, if you are looking at your watches. I don't mean to have you all walk out of here depressed. That is not my point. So please don't throw tomatoes and eggs at me afterwards. But what I'm about to walk through, and I think most of you know it, is very sobering. We are in a debt crisis, a very serious debt crisis. And once a country gets into a debt crisis, there's very few options to get out of a debt crisis. Really only two, and we can't take one. So let's look at our problem. This is the US national debt. The dark blue, the mountain that you've seen, is the amount of national debt. We're basically at $34 trillion. The red line is our debt to GDP. It spiked up to 130. It came down with that surge of inflation because inflation whittles away the amount of debt because it makes, you print more money and you got a fixed amount of debt, so it brought it down, but it's already starting to spike back up. And we're continuing to run deficits at a faster and faster pace. And we have structural problems because the biggest population bubble, the baby boomers, starting to hit retirement and draw upon all those social benefits like Social Security, Medicare. This really tells you how bad we've been in the last 4 years. The big red box at the bottom is how much debt we racked up over 232 years. Over 232 years, we racked up $10 trillion in debt. In the last 4 years alone, we've racked up $10 trillion in debt. You can see that line, it's straight up. We're $604 billion a month, $20 billion today. There was a day a couple weeks ago where we literally $50 billion in one day, 833 million per hour. Think of that. Now, this is the problem. How do you get, why do I say debt trap? Because what happens is you build more and more debt. There's a cost to servicing that debt. And the interest cost on that debt starts squeezing everything out. And we know money spent by government has a negative multiplier versus money spent in the private sector has a positive multiplier to the economy. So if you look at the pie graph, this is where the big expenditures of federal government money. The biggest one is Social Security, $1.2 trillion, Medicare, 747, Medicaid, 590. Our light blue is our actual departments, is the functioning of government. The biggest one is our Defense Department of $714 billion. Well, as they took rates way low, guess what? Even though we're racking up debt, the cost of financing that debt became pretty cheap. But now the rates are rising. So in 2022, it was $475 billion. We've already, for federal government, because they operate on a September fiscal year, it's going to be $879 billion. That means the interest cost on our debt, folks, is more than anything except Social Security. That means our interest cost is bigger than our Defense Department. And it's going straight up. This is the debt trap. So, what's your options? You got one of two options if you're in this position. And many countries all through the history of time have all gone through this. Either you default, like Argentina Thailand, you could go through the litany of country, every African country, almost every South and Latin America. Argentina keeps doing it about every 20 years. I don't know why anybody gives them money. They're getting ready to do it again. But Greece, you name it, it happens all the time. So you can do that. The problem is the US government can't do that. We're the one party that can't. Why? Because if the US government defaults, we will collapse the whole global world into a depression of unimaginable levels for generations. You wipe out every financial institution. You wipe out every pension plan. You just blow apart the whole financial system all over the globe. So what's our only option? It's one thing, inflation. And if you think inflation's been bad, you wait. Right now, and again, I'm going to get a little technical, this is the maturity schedule of our debt. So the upper right-hand graph. The amount of debt we have to roll every year just keeps getting bigger and bigger and bigger. And right now, we have to roll $18.3 trillion. Well, buyers of our debt, foreign governments, I put China and Japan because I didn't want to have too many lines on a small graph. China's going way down. Japan has just been kind of stuck. And by the way, Japan may blow up because they have an even bigger debt crisis than us. So they're both being hammered. So we've got this huge wave of debt maturities. So what caused the 10-year to start lift is because we started getting a supply-demand imbalance. There wasn't enough buyers of that 10-year Treasury paper at the rates they were offering it. And this is the problem that could come. Now, something happened 2 days ago. And again, I don't know if any of you are aware of this, why rates, the 10-year and longer rates dropped. Because over the weekend or on Monday, Stanley Druckenmiller, who's one of the great investors of the last 50 years, blasted Yellen for complete negligence and incompetence of not financing a lot of our debt longer term when rates were really low. Why didn't you take advantage of that when rates were so low? The next day, because rates are now high, she says, we're not going to finance anything long. We're going to pull all our financing in short. So it said to the market, well, okay, you're not going to have the supply because people kept seeing it, and the Fed can control short rates. They have a harder time controlling long rates. So that's why the 10-year and longer durations took a bit of a drop. But the simple problem is we have to roll $18 trillion of debt right now. And where are the buyers going to come from? So it gets down to the last slide. How big will the Fed balance sheet grow? In the next 2, 3, 4 years, there's really only going to be one buyer for our treasuries. I shouldn't say one. There will be plenty, but one to absorb what comes, and that's the Federal Reserve, the federal government's bank. But what does that mean? When they start buying treasuries, that's quantitative easing. That's what happened to the Weimar Republic after World War I that caused hyperinflation. That's what happens in places like Argentina, which has inflation rates of 100%. And I'm not saying we're getting there, but this is a real problem. And I think it's going to have huge implications for our society. I think we're getting ready to go through a lot of resets. But you know what I'd love to say to the politicians? If you dug yourself a hole and you got yourself deep a hole, at least what's the first thing you got to do? Stop digging. Stop digging. But they keep wanting to spend money. So I'm not going to end. I'm going to get onto my predictions. But I'm not going to end just on a sour note. We all know sometimes when things go well, everything's going great, is when we can get off track as a person or as a society. And sometimes it's through tough times that we right ourselves. You know, it's the person who's became addicted or alcohol that fell flat on their face and they got to make a decision. I'm going to lie there and die, or am I going to pick myself up and change my ways? Well, I think our country is going to be forced, and maybe there's a lot of good things that will come out of that. because I do believe tough times bring resilience and benefits with it. All right, drum roll. What are my predictions for the year ahead? Predictions for the economy. The economy will run out of, or the consumer will run out of gas, and the U.S. will enter a recession that could turn into a hard landing. A lot of it will depend on that supply-demand imbalance on treasuries. GDP will be lumpy with one potential positive quarter because there's still a lot of that government spending that will last all through 24. But what will happen with the consumer and the corporate sectors and real estate, I think, will pull us into negative. 25, I get really kind of dark and negative, unfortunately. Unemployment rate, corporations will start to downsize, but I think unemployment will slowly lift, but it won't be as extreme because it's so hard to find good employees. That's just a fact. Interest rates, I think the Fed's over. They didn't raise rates yesterday. I think they're pretty much tapped out. Could they do one more 25 basis point rise? Possibly, but I think it's pretty much over. Do I expect them to cut? Yes, they could be cutting mid next year or end of, call it the May, June time frame. But I don't think they're going to do significant cuts because, again, inflation can pick up. But if they do anything more than 75 basis points, it's because we'll be in a full-blown crisis. Something is broken. Something is going really bad. Balance sheet, the Fed will continue with quantitative tightening through the remainder of 23, but will be forced to stop again at some point in 24. Asset values. The equity markets will have a sell-off of 15% or more in the next 6 months as investors realize the country will be entering a recession. I think the equity markets will have a little rally into the end of the year, frankly, because of what Yellen announced and rates coming down. So I think you'll get a little bit of a year-end rally in how money flows go on into the equity markets at this time. But then I think we'll have a sell-off. And then once the Fed pivots, our equity markets will have a quick, small spike, but moderate at some level, and then may start drifting back down depending on how bad the recession gets. Residential housing values will continue to decline by up to 10%, but will remain more resilient, again, because of limited supply. Watch, though, the investor bid. If that starts cracking big, that will put more supply on, and it could go down more. Commercial real estate, it will continue to decline. Foreclosures, distress sales will become a significant part of transaction volumes. Multifamily will surprise to the downside, given its overperformance. Remember, I've said this many times. Whatever asset class did best in the last downturn will do worst in the next. Whatever did worst in the last downturn will do best in the next. Why? It's human psychology. And I could get into that more, but it's just the way it is, and how banks lend and what people do and all the rest. All right, global and political predictions. Only a fool would try to predict anything in politics this year ahead. Nevertheless, here are my foolish guesses. I mean, you got one of the candidates, I just saw this today, they're trying to take Trump off the ballot in Minnesota. I don't know how many lawsuits he's got going against him. Biden, I don't even know if he will get through this next year and whether he gets primaried. We got RFK in there. We've got No Labels launching a third party. I mean, it is so crazy. But here's my best guess. This is the one I'm probably most certain of, these first two. Joe Biden will not be our president after the next cycle. You can already tell large parts of the left are worried about his performance and where his poll numbers and are trying to push him out. That has been going on for now almost a full year, if you know what's going on in D.C. and across the country. You've now had a congressman run against him. You could see something build where Joe Biden isn't even the person on the ticket for the Democrats by the time we get to the presidential election. But if he is, it is very hard to recover from the numbers where he is today. I mean, these are numbers that are worse than Jimmy Carter's. These are numbers worse than where Donald Trump was at this time in his presidency. It's really hard. And when you think of what's coming the year ahead, I just do not see him being the president again. The Senate, I think Republicans will retake the Senate. And a lot of it's just due to election map. This is a favorable map for the Republicans. More incumbent Democrats are up for election. I think the Republicans will safely take West Virginia, Ohio, and probably Montana. And then that will give them a one-seat majority. And then the Republicans have a pretty decent chance of picking up 3 other states. My home state, Wisconsin, is one of them. So keep watching that. And then lastly, the House of Representatives, it's so unpredictable. I think there will be a number of incumbents wiped out on both sides, but I think probably the Republicans withhold a slim majority. My global prediction concern is there's a 50% chance that China goes in and blockades or invades Taiwan. Look, don't think for a second the attack on Israel was not orchestrated with Russia. Look, Iran hit their 3 greatest enemies: Israel, the US, and Saudi, because the Saudis were getting ready to normalize under the Abrams Accord with Israel. And you know, Iran is Shia and Saudi is largely Sunni. They're both trying to be the global power in the Middle East. So you hit the Iranians hit the Saudis, they hit Israel, they hit Iran. Well, for Russia, who controls Syria and has big influence on Iran, and by the way, Iran has total control over Hamas and Hezbollah, which is in Lebanon. It's a perfect thing for Russia because now we're sucked into another conflict that we can't focus on Ukraine. And for China, it's totally perfect because we're dealing with these 2 other conflicts, and President Xi, just like President Putin said, I will take Ukraine at one point in a speech, President Xi said, I will deal with Taiwan in my lifetime or in my tenure as premier. So I think that's the big, big black swan tail risk, and I think it's very high. The other one I didn't get a chance to put on here is Japan. Japan has really, really deep debt problems. So those are my global predictions. So I'll end on this. Every adversary, every failure, every heartache carries with it a seed of an equal or greater benefit. As I said, sometimes it's tough times that make us better, make us stronger, give us more grit, and puts the country right on the right path. And I think that's the hope for this country. And then lastly, for investing, as I said last year, the primary goal in investing in the years ahead should be the return of your capital and not the return on capital. So I'm done. Thank you. Appreciate it. I wish you all a wonderful year and look forward to seeing you next year.